E-mini S&Ps end the week lower about 2.5% from last Friday in what was about a 200-point range this week, which we've seen before, but ultimately ends to the downside heading into the weekend with lower risk appetite. As we saw E-minis rally midweek, we go into Friday, we see them heading lower. A lot going on in the world and a lot happening next week, possibly the main reasons why we're seeing a risk off trade as we head into the weekend. This actually, though, was our lowest weekly close at right around 4,200 since all the way back in May of 2021. So obviously we've traded below this level since May of 2021, but we haven't seen a weekly settle below this level, at this level or lower since then. So ultimately, E-mini's setting up for possibly a little bit of a bearish sentiment next week, and we'll talk about that in a moment. Now, what does this all mean for volatility? Well, the VIX index, which typically trades inversely to price action, so as the E-minis rally, we see the VIX come down and vice versa, that has kind of gone out the window, as have a lot of historical relationships. We talked about that earlier this week as we saw the dollar rise and gold rise, and we saw the dollar decline and gold decline. It's the same that we're seeing in volatility. As volatility got very elevated across all asset classes, it did come down this week across all asset classes, despite the fact that equities were lower heading into the weekend. We actually saw the VIX index nudging lower, but still holding at a key 30 right now. So while it is lower from what we've seen over the last, call it 6 months to a year, it remains elevated given the fact that there are a lot of risks out there, not just economic, central bank, and geopolitical. So add them all up, and the VIX index remains just at that 30 level heading into the weekend. Lastly, what do we have next week? What could continue this trend, or what could push us back higher? Well, we've got a slew of data coming out. We've got PPI, retail sales, we've got a lot of manufacturing data, but all eyes are going to be on Wednesday's FOMC decision, where the Fed is expected to raise 25 basis points. This will be the first move in rates since they cut rates heading into the pandemic back in March of 2020. So ultimately, the market had been anticipating somewhere between 25 and 50 basis points, and now it's all in for 25 basis points based on the Fed Fund futures. So right now, since we're not really anticipating a shift more in rates, more than 25 basis points, I should say, it's going to really all be about a couple of things. One, the statement. Two, Mr. Powell's press conference. And three, the Fed's forward guidance. So all those things wrapped up will likely give us some kind of picture of where rates will be down the road, or at least where they could be down the road. And clearly a more aggressive Fed would suggest that the economy can handle higher rates sooner. That may be positive for equities. However, if they look to take a step back, given the high inflation numbers that we have, and given their talk about wanting to bring those inflation numbers lower, the fact that they may not act more aggressively could be their concern about growth, which right now is hovering at about 0.5% for first quarter right now. Now we still have a couple of weeks left in first quarter, but right now the GDP numbers are showing a very weak number for first quarter. That could keep the Fed from raising more aggressively, and that would obviously not be very positive for equities. So heading into the weekend, E-minis hovering right around 4,200, down 2.5% on the week, with all eyes focused next week on March FOMC.